Want to make smart investment decisions but don't know where to start? One thing you must learn is how to read a balance sheet. You can see a company's financial health by looking at its balance sheet. It tells you whether the company is growing or struggling. This is the key to making wise investment decisions. Here at The Winning Journey, I'll explain it in simple terms. By the end of this video, you will understand how to use a balance sheet to make informed financial decisions. Once you comprehend this, you will be able to determine the actual worth of any business. Stay tuned. In the end, I'll reveal a secret that top investors use to identify undervalued companies. This tip might help you discover ways to make more money than you ever imagined. What is a balance sheet and why does it matter? A balance sheet resembles a snapshot. It shows the company's assets and liabilities. This simple document provides you with a comprehensive view of a company's value. Furthermore, it provides you with an overview of the company's financial situation. For instance, it indicates whether a business has too much debt or enough cash. Consequently, it aids in assessing risk prior to investing. Now, why should you be concerned about this? Because investing without first reading a balance sheet is like investing blindly. You won't be able to determine the company's strength. You won't be able to tell whether it can expand or pay its bills. Therefore, it is essential to comprehend this sheet. Even if you are not an investor, this is an important consideration. Let's say you want to start your own business. Perhaps you want to join a company. The balance sheet in both situations demonstrates how successfully the business operates. As a result, you can avoid poor deals and make better decisions. Prominent figures in the financial industry depend on this tool. In fact, Warren Buffett once stated that, "Accounting is the language of business, and you can learn to speak that language if you can read a balance sheet." To put it another way, would you purchase a used car without inspecting the engine? Obviously not. You want to understand what you're purchasing. Here, the same rule is applicable. The balance sheet represents the hood. It displays the company's engine. In summary, this brief report can assist you in avoiding poor investment choices. It can also help you discover hidden treasures. That's why learning how to read it is an essential skill. The 3 key elements of a balance sheet. Every balance sheet has 3 major components: assets, liabilities, and equity. Together, these 3 provide the complete financial picture of a business. Knowing how to interpret each one will help you determine whether a business is stable, strong, or on the verge of failure. Let's break them down. Assets. Assets are valuable possessions owned by a business. These can be used to generate income or converted into cash. Assets are classified into 2 types: current and non-current. Current assets include cash, receivables, and inventory. Over the course of a year, the business can turn these into cash. However, non-current assets are long-term. These include real estate, machinery, automobiles, and even patents. They are not intended for immediate sale, but they aid in the operation and expansion of the business. For instance, Apple's current assets include its cash and iPhones in stock. Its office buildings and manufacturing equipment are considered non-current assets. When taken as a whole, these demonstrate what Apple owns and uses to conduct business. In short, assets indicate what resources a company possesses to generate revenue. Strong assets could be an indication of a successful company. However, to see the big picture, always compare them to liabilities. Liabilities. Liabilities are duties and debts owed by the business. They are classified as either current or non-current, just like assets. Current liabilities are short-term. These consist of short-term loans, rent, and bills that are due within a year. Non-current liabilities are long-term. These consist of mortgages, bonds, and large bank loans. A business may be in trouble if it has too many liabilities. It might struggle to pay bills or grow. However, not all debt is negative. To grow more quickly, some businesses take out loans. The key is to determine whether the company can handle its debts. If liabilities exceed assets, that's a red flag. It might indicate that the business is drowning in debt. So, before you invest, always take a close look at this. Equity. Equity demonstrates the company's true worth. It is what remains after all debts have been paid. In other words, equity equals assets minus liabilities. Additionally, this is known as shareholders' equity. It belongs to the people who own the business. A company with a high equity ratio has more assets than liabilities. That's encouraging. However, low or negative equity is a warning sign. It might indicate that the business is experiencing financial losses or has too much debt. One of the most important things you need to remember is that a balance sheet must be balanced at all times. Assets equals liabilities plus equity. When you check a balance sheet, you are looking at more than just numbers. You're reading the company's actual story. Equity allows you to determine whether it is a good idea to invest or not. How to analyze a balance sheet. Step by step. Reading a balance sheet is one thing, but analyzing it is another. To truly evaluate a company's health, you must examine the numbers. These numbers indicate whether the company can expand, pay its debts, or fail. The balance sheet becomes your best tool once you know what to look for. First, pay attention to the main elements that demonstrate a company's strengths or weaknesses. These include ratios that provide information about the company's financial management. You don't have to be a math whiz. Just understand what each number means and how it relates to the big picture. For instance, certain figures indicate whether the business is drowning in debt. Others demonstrate its ability to cover immediate expenses. Consequently, these checks assist you in identifying profitable investments and avoiding poor ones. Debt-to-equity ratio. This ratio demonstrates the amount of debt used by the business to expand. It makes a comparison between the company's assets and debt. The formula for this is simple. Debt-to-equity ratio equals total liabilities divided by shareholders' equity. The business might be taking on too much risk if this figure is high. That is a warning sign. It implies that the business may not be able to pay back its loans if sales decline or financial difficulties arise. A lower ratio, however, indicates balance. It demonstrates that the business is expanding with its own funds rather than just debt. A good rule is to look for a debt-to-equity ratio of less than 1. However, always verify the industry standard. Certain industries, such as banking, frequently have higher ratios. So, always start by looking at this number. It reveals whether the company is borrowing wisely or recklessly. Liquidity ratios. Next, see if the business can cover short-term expenses. Liquidity ratios are useful in this situation. They demonstrate whether the company has sufficient cash or liquid assets on hand. The two common formulas for this are current ratio equals current assets divided by current liabilities. Quick ratio equals current assets minus inventory minus prepaid expenses, divided by current liabilities. The current ratio indicates whether the business has enough short-term assets to pay off its short-term debts. A ratio greater than 1 is positive. It indicates that the business has enough money to cover its expenses. The quick ratio is more strict. It eliminates inventory since some products might take a while to sell. This demonstrates the business's actual short-term strength. In summary, the business is probably doing well if both ratios are strong. However, exercise caution if they're low. It may be short on cash when it is most needed. Equity growth over time. Lastly, see if the company's equity is increasing. Equity is the amount that remains after all debts have been paid. If it continues to grow, the business is probably doing well. Check out previous year's balance sheets. Does equity increase annually? If so, the business is increasing its value or keeping more of its profits. On the other hand, falling equity could indicate trouble. It could indicate declining profits or increasing debt. Therefore, pay attention to the trend rather than just the numbers. In fact, smart investors frequently buy into companies with consistent equity growth. It demonstrates durability, strength, and trustworthiness. To put it simply, a balance sheet analysis is a way to distinguish between the positive and the negative. A strong business has increasing equity, stable cash flow, and minimal debt. Use these 3 checks, debt ratio, liquidity, and equity growth, to make safer, smarter investments. That's how professionals read between the lines. Practical example. Now let's bring this to life. We will examine the balance sheet of an actual business. For this, we'll use Apple Inc., one of the world's most well-known technology companies. Its balance sheet demonstrates how a strong company manages money. Let's start by examining Apple's assets. In its 2023 annual report, Apple reported $143.5 billion in current assets, which included $29 billion in cash and $29 billion in accounts receivables. It means Apple has a substantial cushion to meet short-term needs, such as paying bills or investing quickly. Next, we look at Apple's liabilities. The same report indicates $145.3 billion in current liabilities, which include unpaid bills and short-term loans. That puts Apple's current ratio at about 0.99, meaning it has slightly less in current assets than it owes in the short term. While this isn't a major red flag for a giant like Apple, it does suggest a tighter short-term liquidity position than you might expect. Let's zoom out now. There are approximately $290.4 billion in total liabilities, both short and long-term, compared to $352.6 billion in total assets. Given that Apple has $62.2 billion in equity, the debt-to-equity ratio is approximately 1.5. While the debt appears to be high, Apple has strong cash flow, which helps manage it. Finally, we'll look at equity growth. Apple reported $56.95 billion in shareholder equity in its 2024 annual report, a decrease from $62.1 billion in the previous year. It's not always a bad thing. Apple has been conducting aggressive stock buybacks, which reduces equity but increases share price. In summary, Apple's balance sheet demonstrates a profitable, cash-rich company that makes sensible use of debt. Their ratios are strong, and despite falling equity, investor confidence remains high. Because of this, it's important to consider the whole picture rather than just one figure. This demonstrates how examining a balance sheet can help you see past the hype and uncover real worth. The secret of top investors. Curious about how successful investors outperform the market? They don't make guesses. They read the numbers, beginning with the balance sheet. One of the wealthiest investors in the world, Warren Buffett, built up his fortune by identifying profitable businesses that others overlooked. What's his secret? He seeks out companies that are undervalued, which means that their true value exceeds the value of their stock. Professionals begin with balance sheets. They look for stable equity growth, low debt, and solid assets. The trick is that they contrast these figures with the stock price. The price-to-book (PB) ratio is one of their basic tools. This ratio compares the stock price to the book value. Book value is the net value of assets from the balance sheet. A low PB ratio frequently indicates that the stock is inexpensive in relation to the company's assets. Buffett bought Bank of America (BAC) when its price-to-book ratio was less than 1.0, a clear sign it was undervalued. Buffett puts it simply, price is what you pay, value is what you get. Even if a company is expensive, it might still be a good investment if its balance sheet is strong. Take Apple Inc., one of Buffett's largest investments. When he made his investment, Apple had substantial equity, a lot of cash, and strong free cash flow. According to the balance sheet, even though the stock price was rising, the company's value was increasing even faster. Buffett also avoids companies with excessive debt, regardless of how popular they appear. Even with a lot of hype, he passes if the liabilities are too high. To put it briefly, top investors don't follow trends. They follow the books. You can do the same and possibly discover the next undiscovered treasure by learning to read a balance sheet. The next time you examine a business, look at the numbers rather than following the trends. So, which business will you analyze first? I'd love to know. Thank you for watching till the end, and if you found this video helpful, don't forget to give it a thumbs up and subscribe to get more simple money, investing, and smart thinking tips.